So you mentioned the Mineral Resources, Nick Scali, Premier Investments, CSL. Are there any other stocks that are sort of really piquing your interest at the moment that you're spending a lot of time researching on that you're allowed to sort of share with the masses?
Share with the masses, yeah, sure. Well, one that we just put out our quarterly and we talked about this stock in our quarterly. So actually 2 stocks, so I'll talk about them. Tabcorp and Helios. So both fall into this category of businesses that we like where basically there's some asset rationalization opportunity where you can shrink the business and get better returns. And I think, broadly when I think about investing, there's 2 types of businesses you want to own. There's your CSLs and your REAs and your really good businesses where you make money. The only thing that everyone knows they're good businesses. They're always on high multiples. Basically, the only way that you make money is by holding them for longer than people. Everyone expects a fade in their modeling. And if you do the work that suggests that either the earnings expectations are too low or that people are fading the earnings too quickly and the quality of their barriers to entry and their sustainable competitive advantage mean that they're going to make super profits for longer than people think. So those are businesses where you want to own them for a very long time. But then there are other businesses that people unloved businesses where, reversion to the mean can happen quicker than people think. And that the best type of business like that, the best kind of turnaround is one where you've got a good business and a bad business. And you can do something about the bad business, whether sell it, spin it off, and then you've left with the good business and everything re-rates. Like an example of that, I wouldn't call it a bad business, but Wes Farmers,
I was just going to say that.
Yeah, it's not. It's definitely
see you later, Coles. Bye.
Exactly, but it's not.
Sucking up all the capital.
Coles isn't a bad business. Coles isn't a bad business, but it was more capital intensive, and I think that Coles does about a 15-20% return on capital. Bunnings 65% return on capital. Yeah. It was being lost within the value of Bunnings was being lost within the conglomerate group. And so that was a really successful example. So for Tabcorp, they have the lotteries business. It's 65% of their earnings. And lotteries, fantastic business. I would call it, a toll road like business, but I actually think it's had a better year than the toll road. So
a lot of that is actually Bryce buying lotto tickets through COVID.
Oh, right. Yeah. Well, that's the thing is and it's got this big tailwind of shifting online. Like people spend more money when it's online. They don't have to pay 10% to the retail, to the news agents when people buy it online. So for many reasons, it's a good business. I think we all know that. And then wagering's been a real problem child. And now they're in this situation where, so when we bought it, we thought that they could just spin off wagering. Now it looks like there's a number of bidders who are interested in buying the wagering business. But either way, it comes down to the fact that you've got different natural investor sets. Pension funds that have a very low cost of capital would be pretty happy to bid lotteries business standalone up to a pretty high multiple, but they don't want the cyclical wagering exposure. So when you split those 2 businesses, you're going to realize the value from a sum of the parts perspective. I think you're going to make money from realizing the different cost of capital for those 2 businesses.
I'm surprised in Australia that wagering's cyclical. I would have thought that would be as structural as...
Yeah, you know what? It actually is. If you look at the history, like the growth CAGR of wagering spend, it is a structural growth story. The problem for Tabcorp has been competition. They used to make a lot of money through tote, and the pricing is just too high versus the corporate bookmakers' fixed odds. So their price has been coming down, and they've had a number of headwinds that way as the market sort of opened up and you've had a number of new competitors come in. Yeah. So their earnings have actually halved in that business. So it hasn't even been cyclical. It's been a one-way structural ticket down. But there were enough reasons that we thought that was sort of bottoming out. Plus we thought, the corporate interest angle that the stock was